So if I have a $10 million apartment complex and we're looking for a $7 million loan, how are you going through and looking at the numbers to verify value, NOI, and where you think the loan will come in at?
So we always start with the operating revenue. What rents are coming in if it's multifamily, or monthly rents are coming in, especially on multifamily, and then any ancillary income through whether it's pet rent, utility rent, what have you. And then we always have to take a vacancy factor on that. And it's generally speaking, it's going to be the greater of 5% market and actual. So if you have actual vacancy 3%, market vacancy of 4%, and we're going to have to use automatically a 5% on vacancy on the underwriting. That's market standard. And generally speaking, correct me if I'm wrong, but if you have apartment building that is more than 95% occupied, then are you probably not going high enough on the rents, or what do you think on that?
If you or someone you know owns an apartment community, listen up. Storyboard Living is actively seeking 40 to 250 unit apartment communities within a 3-hour drive of St. Louis, whether that's Carbondale, Illinois, Columbia, Missouri, or St. Louis County. We're easy to work with and competitive on pricing. You can send information to deals@storyboardliving.com. That's deals@storyboardliving.com. Mitch, thanks for taking the time.
Thanks for having me, Raj.
Thank you for the awesome pullover. I'm sure anyone watching will notice I have the Gantry logo and not the Storyboard logo.
Yeah, no, Gantry, they treat us right and they treat our sponsors right too. So thank you very much for having us, and we're very grateful for you letting us be on your platform.
Yeah, I'm excited to talk about your story and what Gantry's doing in St. Louis. You've been in real estate finance for over 10 years. You've completed over $2 billion worth of loans in terms of helping them close, whether it's as an analyst or as a producer. And in the last 12 months, you've originated and closed over $30 million in loans, shopping centers, retail, multifamily, a couple other things. Can you give us some detail on the deals you've done recently and what that 30 plus million is comprised of?
Yeah, so the 30 plus million, I closed beginning of this year, a $20 million deal for a repeat sponsor of Gantry out of our St. Louis office. It's a great grocery anchored product, which our lenders really love. And this one ended up going through a CMBS transaction, just due to the nature of the beast and the pricing and the interest only period. The other parts that, or the other transactions that I closed on included three multifamily deals. One was for a local sponsor, or they were all for a local sponsor here. Two for the same Fannie. One was a Fannie deal. One was the other was a Freddie deal.
So Fannie and Freddie today are still pretty active. Is that accurate to say?
Yeah, they are active. You know, last year they didn't quite meet their quota to put out in terms of dollars. So this year they actually up the amount that they need to put out. So they are hungry for deals right now, much so that kind of the general consensus is, you know, spreads for Fannie deals right now can generally start at 125 basis points over, let's say, the 10-year treasury. And that is very attractive right now for multifamily sponsors. And that's for loans, generally speaking, above 6 or 7 million.
Before we get too far into the weeds of real estate financing, because I know you're going to have a lot to share, and even what you just shared, I think we can go into more detail on that as well. But before we go into that, can you give some background so listeners, viewers know who you are in terms of where you grew up, how you grew up, and your first maybe foray into the real estate world?
Yeah, so I grew up here in St. Louis locally in Fenton, Missouri. Middle-class family, working class, pretty typical, you know, mow lawns around the neighborhood, try to earn some money. Aid stand was one of the first thing I did. And then I actually went out to the University of Missouri, studied in their finance and banking program. And I had the opportunity to go abroad to New Zealand and Australia for a couple of weeks with some fellow classmates, learned about the tourism and their economy down there. And it wasn't until on the way back that I really learned about or got the idea of going into real estate. And that was through just a casual conversation with someone next to me while our plane was delayed. She was out there looking at a piece of land. She was from Denver, but wanted to invest in this piece of land. And that really kind of sparked my interest. And it also helped that I needed to boost my GPA a little bit. And it was kind of known that, real estate isn't rocket science, but it is a tenacity game. And I was able to get a good base there. Kind of fast forward to graduation. Had a couple job offers lined up that weren't in real estate, but I decided I want to go pursue real estate. So through a family member, she actually introduced me to a contact here in St. Louis who is high up in the real estate world, and he was very open to helping me network and find my first job. So he introduced me to a handful of people, one of which was my current boss and mentor. We really hit it off, and he was impressed with me for whatever reason. I don't know. But flash forward to 10 years, and I'm back with the company and have great experience there.
When you started with them, were you in the role you're in today, or were you in a different role?
I started off as an analyst and closer. So my first day there, my boss, Joe Montilli, if you're in the St. Louis real estate world, you probably know the name, if not, or have transacted with him. He kind of came in, gave me a deal to underwrite. So basically come out to a value. And I looked at it like my eyes were crossed. I didn't quite know what to do. So that was my first day, first time on the job. And I started off as the analyst. Anything that crossed my desk to start off with, I would go through the closing process. So I would underwrite it. Joe would take it out to the market. I would answer lender feedback of due diligence questions. And then from there, we would get a loan signed up. And then I would see it all the way throughout the transaction in terms of, the due diligence that's required by the lender, all the way through third parties, title survey, all the way to closing and funding. And through there, I kind of worked my way up from the smaller deals to the more complicated deals to where I was put on some of the top accounts for the company. And then flash forward now, closed over $2 billion as an analyst, closer, and a producer. So that's kind of the long way of how I got here.
And if you can give the name, if you don't want me to give the name, that's fine. But that was Triad, correct? And then Triad is now Gantry?
Correct. So Triad had been in St. Louis since 1990, a very big powerhouse in the mortgage banking industry for the Midwest and St. Louis. Typically, it wouldn't be unusual to have 500 or 600 million out of the St. Louis office. And so one of the best things that ever happened was going to a high power shop. And then fast forward now to the fall of 2024, there were some older partners in Triad that wanted to they wanted to exit the industry, and this was kind of the exit strategy that they had. So they were approached by Gantry, what is called Gantry. They're headquartered out of San Francisco, and we are now Gantry, which is the largest privately held mortgage banking firm in the country.
Wow, I didn't know that. That's very interesting. So does that give you more access to like maybe analytics or anything else? Like what's the advantage of being with the largest in the country versus like, let's say a smaller shop?
Yeah, so being with Gantry, that gives us actually more access to capital and the leaders of the capital. So we might have had we had great relationships with, call it 20 to 25 life insurance company lenders. And now with Gantry, we have access to over 40 life insurance companies that we're correspondents for out there looking in the market for property types that they want to lend on. And with that, the amount that we produce, we tend to have more access to the higher ups at those industries.
I'd love to go, if you're okay with it, from A to Z in terms of what a loan looks like behind the scenes, because Ron does a good job of keeping me pretty shielded from all of that. So if I have a $10 million apartment complex and we're looking for a $7 million loan, how are you going through and looking at the numbers to verify value, NOI, and where you think the loan will come in at?
Mm-hmm. So we always start with the operating revenue. What rents are coming in if it's multifamily, or monthly rents are coming in, especially on multifamily, and then any ancillary income through whether it's pet rent, utility rent, what have you. And then we always have to take a vacancy factor on that. And it's generally speaking, it's going to be the greater of 5% market and actual. So if you have actual vacancy 3%, market vacancy of 4%, and we're going to have to use automatically a 5% on vacancy on the underwriting. That's market standard. And generally speaking, correct me if I'm wrong, but if you have apartment building that is more than 95% occupied, then are you probably not going high enough on the rents, or what do you think on that?
No, you're right. Your rents are probably too low. And then that 5%, are you using that like whether I have a deal in St. Clair County or St. Charles County, or is that based on the submarket as well?
So the 5% is the lowest vacancy that we can go.
Okay.
So if St. Clair County's vacancy is 7%, we're going to underwrite that. If the rent roll is 10%, we're going to use that.
Got it. Understood. So we go from you're going to the gross potential rent, and then like kind of your actual collected rents, and then on the expense side, how are you guys looking at expenses versus what I send you as a borrower or sponsor?
So we take a look at the borrower's expenses. We look at them on a per unit basis. And from there, generally they're in line with what we see as market, whether it's a garden style or a townhouse type unit. And then if we see that something that might be off, like let's say payroll is lower than what market should be, we'll be like, hey, Raj, why is your payroll lower here? Are you using a scattered property manager? Say they have 3 properties within a 3-mile radius, or do you have one dedicated property manager that you're, maybe not paying quite market at that point? So we try to verify what's going on. And overall, we will look at the operating expense ratio. That's always a big tell as well. And typically speaking, newer product, and please correct me if I'm wrong, but what we're looking for at least is, you can't generally go lower than 30% on the operating ratio. That's just going to be too low in any market if it's below that. But typically we're looking for something between 35 and 40% is a very well run machine in market.
On newer product?
It could be newer, but it could also be a little more seasoned product as well.
Okay. So when it comes to the expenses, like with you being a larger shop, do you have access to more data? Like, are you able to pull more information on what market expenses should look like for each line item, just because you're with Gantry? Or is it just, everyone will have access to the same stuff? How does that look behind the scenes? Yeah,
for us, we have a servicing portfolio of 2,600 properties across the U.S. as part of Gantry, and a $23 billion portfolio of serviced loans. So that's one way that we can see, like in real time, what are market expenses. Maybe on the West Coast, we know on the West Coast, insurance and taxes are through the roof, same with Florida. But for specifically like the St. Louis or the Midwest market, we're pretty well in tune with what's going on because we're talking with sponsors daily. We're looking at operating statements. So we keep track of the metrics that show how the properties are operating on a market basis, as well as constantly keeping in contact with sales advisors and appraisers and so on and so forth.
Although you're working on behalf of the client, a part of your job, it sounds like, is to trust but verify so that you don't damage your reputation with lenders. Is that fair to say?
Yeah, no, trust with lenders is number one. I mean, they're holding the bag to financing, especially when you're talking about our sponsors, and we're the eyes and ears on the ground for them. If we send them a pretty, and a sponsor has fabricate. I don't want to say fabricated necessarily, but they're inflating or deflating something, and it comes around, and they're hiding something from us on whether it's the title report or whatnot. That damages our reputation as well as the sponsors. So if we mess up on behalf or when we're working through something with our lenders, it can be detrimental, and you got to work through it, and it's not always easy or fun conversation. So we need to trust and verify.
Makes sense. So you've trusted, you verified, you have your final NOI, and maybe you've applied a market cap to that. So you have the value. You tell the sponsor or the borrower what that value looks like. And then what's the next step from there? And then behind the scenes, are you having conversations with appraisers already to kind of verify, like, hey, I think this property is worth X. Would you agree with that? Or what does it look like on your end? Yeah,
I would say it depends. A lot of the times we have enough trust and market knowledge to say this property would appraise at a 6 cap. We have a number of comps, whether it's from sales advisors or recent postings or appraisals that we've done before on like kind product recently. So that's a lot to where we gain our market knowledge. On times where maybe it's an out of market deal that we're not necessarily familiar with what's going on and what's trading, that's generally when we might reach out to appraisers or other market contacts that can help us and verify and make sure that at the end of the day, we're able to execute on what we're planning on delivering.
I appreciate you sharing that. So I gave you the scenario of me wanting a 70% LTV loan.
Mm-hmm.
Is that typical, or is it typical for you guys to look at the property and then tell the borrower, like, hey, depending on your goals, we can either go in this direction or that direction?
Mm-hmm. Yeah, I would say a lot of times borrowers say, I've got a current debt of $7 million that I need to refi out, and I've owned it for X amount of time. So I'd like to pull a little bit of cash out as possible, if possible. So what we end up doing is saying, well, we need to see the numbers. Well, we just need to see the numbers first to tell where we can really land at. We think, based on it depends on the operating history, and everything else. So it depends on the scenario. If the borrower has an upcoming maturity, or if they're looking to capitalize for a lower rate environment to, just set long-term debt at lower interest rates. But typically the borrowers will come to tell us, I want a loan at this amount. I think this is worth this amount. And, we'll say, well, let us take a look, and we'll give you feedback on where we think the market is at for this and go from there, because sometimes the value might be there, but in times like this where interest rates are higher than they have been the past 3 or 4 years, that's where we may or may not be able to meet that ask, because whether it be debt service coverage constraints due to the interest rate and the loan amount that's being requested.
Got it. And then would you also look at whether or not the owner plans to hold for, another 10, 20 years, or if, maybe it's a better fit for them to go bank? Like, would you go bank and not perm in any scenario?
Yeah, no, that's a very good point. So with that question, we always ask what the borrower's business plan is, because with what we do with life insurance companies, or if we place Fannie and Freddie agency loans, there's going to be prepayment penalties, which can be costly. So we want to make sure that we're finding the right loan for them. And sometimes we'll say, if a borrower says, I plan on selling in 3 or 4 years, we might be able to say, well, we can find you a loan for 3 years at fixed rate, but honestly, we're not adding value to that. So we can find you a bank loan, or we can or pass it along to a bank as well.
And as you're kind of reaching out to some of these lenders, and let's say the borrower has decided that they want to go perm. So you're reaching out to like Life Co's, Fannie, Freddie, whoever else you might reach out to. Are you battling behind the scenes to get the best terms, or is it relatively standard based on the numbers? They're going to provide X, Y, and Z as the terms, and there's not a lot of wiggle room.
Yeah, I mean, I would say in our underwriting, especially, with our lenders, we try to get as aggressive as we can. So for us, we want to fight for our sponsors as much as we can. And, but we also have a duty to place good loans with life insurance companies and Fannie and Freddie. So we're trying to find the different leverage points that maybe the sponsor has 2 or 3 that they really want and are non-negotiables, whether it's the length of the loan, the interest rate, or the loan amount itself. And then it'll be a negotiation in terms of who can provide the points that are the major hot topics.
Got it. So let's say, we got the terms back and we decided to go with Fannie on this loan. Once that process starts, the borrower signs off on the term sheet. What does it look like on your end? And then on the borrower's end, what does it look like? And then behind the scenes, are you having to continue that fight? I know if there was a CMBS loan, you might have to continue that fight a little more than you may have to with like agency lenders. So what does it look like? Just walk us through it from your perspective.
Yeah. So for Fannie and Freddie, we are walking with the borrower as much as we can. We're working with them and the agency lender. The lender will come to us with questions, and then we'll work with the sponsor to make sure that those questions are answered correctly. So that way, there aren't any questions when it goes in front of Fannie or Freddie, because they're notorious for asking questions for all the right reasons. And it can be a little painful from time to time, But, Fannie and Freddie, they do a lot of due diligence because they offer some of the best terms in the market for multifamily properties. They are usually the rate leader in terms of lowest interest rates. They are more apt to put money out. So in terms of cash outs, and then also, most properties, when you're financing them, you can get a couple of years IO, if not half term IO, a full leverage loan. And then, on low leverage loans, you can also get a full term IO as well. And IO being interest only too, for people that aren't necessarily aware of some of the lingo. So if you have any questions on that, happy to clarify.
Yeah, you know what? I think it would make a lot of sense for us to clarify just what these different types of lenders are. Like we said, life cos. You talked a little bit about Fannie Freddie, but can you outline the different types of lenders that you work with and then some pros and cons of going in either direction?
Mm-hmm. So our bread and butter as mortgage bankers is life insurance companies. So basically they need to make a rate of return on their insurance policies or annuities. So a lot of that can be put towards corporate treasuries or corporate bonds, or they put it in real estate. And so they're looking for a spread over that. The great thing about life insurance companies is their certainty of execution. You're not going to get retraded unless the appraisal comes in completely wrong, but that's where the trust and the market knowledge of the mortgage banker comes into play. They don't choose anyone to represent them in any market. Did I say they don't choose?
Yeah, they don't choose anyone to represent them?
No, they don't choose just anyone to represent them in the market. They want people that know the market and that aren't going to provide them with bad loans, because it used to be back in the day that we would be the eyes and the ears on the ground, and that's still what it is today. And so one of the downsides of life insurance companies is historically they haven't necessarily been the most competitive in terms of loan to values. So a lot of times when you're talking about conventional loans, which, we'll call it 6 million and up, is, they might top out at 65 or 70%. Maybe when interest rates are lower, you can get a little higher than that. But, so that's where we really shine. And they really love new product and good locations with strong sponsors that are real estate professionals. That's where we're going to shine the most. Now, the agencies that we've been talking about, Fannie and Freddie, they are strictly for multifamily owners and sponsors. They are government sponsored entities, so they're federal, or they're backed by the government. They are the ones for multifamily can get to 75 and sometimes 85% loan to value. As I'd mentioned, they're much more aggressive on proceeds. They will do half or full term IO, and which life companies will as well, but that's typically on lower loan to value stuff. If it's 55 or 60% or lower, you might be a little more apt to get interest only periods. But going back to Fannie and Freddie, it's a great product for anyone looking to maximize proceeds with lower interest rates as well. But the downside of the agencies is you have an idea of what you have going in, but you're not locking rate until the very end of it. So you'll be given what your agency lender says they think that they can do, and it's up to them and us to get it to that point. So they have their eyes and ears on the market. They know what everything's trading at, and then at the end of it, Fannie and Freddie will bless it, and at that point, you can rate lock and close within a couple days. Now, CMBS, that's a whole nother animal. It's a market where if you are trying on any commercial asset to really push proceeds or interest only, or your deal has hair, and by hair, I mean, let's say you've got a grocery anchored asset with, 4 or 5 years left in a secondary market, they're going to be the ones that are really able to execute on that, but they're going to be digging in and into the weeds on that. And then you really don't quite know what you're getting until you're issued the commitment, or in terms of the loan amount and the spread, because the loan amount is going to be based on the rate at which you lock, and to make sure you hit all your debt service coverage ratios and whatnot that the lenders are looking for.
So I've done a CMBS loan. This was 10 years ago. Well, I did a couple 8 to 10 years ago. And what I didn't like about that process was it felt like you are getting retraded no matter what happens. And that's not a knock on anyone. It just felt like that's more of a part of the process than it is with Fannie and Freddie. With Fannie and Freddie, I never got that impression. Closings have all been smooth. I've never done a life co deal. You mentioned you used the phrase mortgage banker, and I use mortgage banker and mortgage broker interchangeably. What's the difference between the two?
So a mortgage banker, so what Gantry does is, or what separates us from the market is we have correspondent life insurance companies as well as access to capital that isn't directly on Main Street, if you will. So, and it's relationships with lenders that have been built over years, and there's the trust, and people know that we can bring them deals and execute, so we can get better terms than, someone who, than a mortgage broker who might be going out and reaching out to a private lender or whatnot. We're not blasting it out to 100 people. We really know our market, who's transacting, who can execute. And on top of that, mortgage bankers, we have a servicing portfolio. So basically we take it from cradle to the grave. Once you bring it in with us is when our process starts. You bring it into us, we underwrite it, we go to application, we close the loan, and then from there it goes to our servicing department. But at that point, once it gets to the servicing department, we're servicing the loan. So we cashier it. If there's any insurance issues that come up, you can call either myself or your mortgage producer or someone in our servicing department. You're going to have a direct contact throughout the life of the loan, and it just takes one phone call, and you'll have someone that knows what to do because we are the direct contact between us and our correspondent lender.
That's interesting. That's pretty awesome. Loan servicing can be pretty frustrating at times when you're reaching out to someone that has never seen the asset, is not in the same city as you, is monitoring a large portfolio and maybe has never talked to you before. So it sounds like with you guys there's a little more of a personal touch. Is that accurate?
Yeah, that's accurate. I can kind of give you an example here
Sure.
of a situation that came up a couple months ago. We had placed a loan for a sponsor, and their insurance was getting ready to roll, and there was a very short time between the conversation that we had with the sponsor and roll. So we got on the phone. The sponsor called us and was like, "Hey, we cannot find any reasonable insurance right now. What can we do?" So we hopped on the phone with our servicing department and the insurance company to make sure that we could find a solution for everyone, and we can lay out the scenario. Because if we have a good property on the books, which we are historically placing loans on good properties, the lenders don't want to foreclose. We're not predatory lenders. We're not trying to take the loan back. We want everything to work out. So we were able to come to a conclusion with the sponsor. They were granted a little bit of time, and ultimately we were able to help them find insurance on the property.
That's awesome. That's a great example of you guys really working with your clients and helping them. I can say that I can't say most, a lot of other servicing departments would just stick to, this is what the documents say, this is what needs to be done, or you're in trouble. At least from what I've heard.
Yeah, no, I mean, every servicing department's different, which I think that's why us as mortgage bankers have a place in the market. To go to, whether it's a CMBS servicer or whatnot, I mean, you're going to have different experiences. And for us, we have a more personal touch, especially with a company the size of Gantry, stature in the market that we have. We pride ourselves on service.
That's great. It sounds like you're still getting a lot of deals done. You mentioned, doing over 30 million in loans in the last 12 months. It's been a challenging environment. I've been hearing of people that just either have trouble with insurance, interest rates, whatever the case is. How are you still getting deals done? And then are the deals working like with the higher rates, or are we talking cash in refis? Are they new acquisitions? Can you give some color on just what you're seeing in a broad sense with the market?
Yeah, I mean, myself, I've seen a little bit of everything. I've recently I've done a cash out on a stabilized property after the sponsor had completed their business plan. I recently had a sponsor do a cash in for a couple million because they were interest rate sensitive, and that was one way to do it. The other was an acquisition. Someone was buying out their partners. So I've been kind of all over the board. There was a period in time where over the past 12 months, we had sponsors were seeing if we could pull out second mortgages as well on the property. A lot of times the numbers just didn't make sense due to certain covenants or financing constraints. But it's really just kind of been all over the board, especially in my experience.
Do you have any recent examples of a deal that was, maybe challenging for some of these reasons or other reasons, and then you were still able to bring it across the finish line?
Yeah, so kind of backing up a little bit, I first reached out to a sponsor here in 2019. Local sponsor has done great work, and and we've just kind of kept in contact. And so with that, he came to us and myself and said, "Hey, would you mind financing this for us?" So we knew the one or two lenders that would go to be contenders for this multifamily property. It ended up ultimately going to Fannie Mae, so which we have a strong relationship with one of the DUS servicers or DUS underwriters for Fannie Mae. And we signed it up, and Fannie Mae at that time was experiencing some delays. They were really slow to give feedback, and it was pretty well known in the market after we had signed up the loan. So I had to, overall, the loan didn't have many issues, except I guess the rising rate environment during that time. I think the Treasury 10-year probably jumped up 30 or 40 basis points at that time. But even with that time, by the time we closed, there was only probably about a 10 basis point difference in when we signed it up. And then we were able to close the full leverage loan at that point based on debt service coverage. And we were able to basically keep the loan amount the same.
That's awesome. It sounds like persistence paid off in that scenario.
Yeah. It's when you're dealing with rising rate environments, it's imperative to keep looking at expenses, making sure rents are tracking, and just making sure that expenses are remaining consistent and, hopefully rents either increasing or staying the same.
What do you think today in terms of rates? Are we in a pretty stable rate environment? Do you have any predictions for where interest rates are going? And I know it depends on the lender and, the type of loan and things like that.
Yeah. I mean, so right now, the bond market, the treasury market is really volatile. It's going up and down. So it's imperative that we're in constant communication with our sponsors who are either looking to finance or are in the middle of financing. So that way we can kind of explain to them what's going on and we can keep them apprised of the situation. In terms of where our lenders are right now, for life insurance companies, there are lenders out there on lower leverage loans that can do, call it 130 basis point spread over the 10-year. I looked earlier today, that was 4.3. So you're looking at a 5.6 loan fixed for 10 years. But typically you're probably going to that's on the low end, but probably 150 to 160 over. So that's, 5.8 to 6%. Now, like I was saying, for agencies, they're going to be the pricing leader and the proceeds leader. So for, a conventional $6 to $8 million multifamily loan on Fannie right now, you might be looking at starting at 125 basis points. And then you can typically get a little lower if there's affordability, what Fannie describes as affordability in the project. And then also, there's also the option of buying down your interest rate as well. And, we've seen quotes on spreads for even at 99 basis points over the 10 years. So, you're looking at a low 5% interest rate loan.
Wow. That sounds awesome.
Yeah. I mean, especially when you're talking about, rates overall, all in interest rates being above 6%, sponsors it's really piquing their interest now that rates have dropped and spreads, especially for the multifamily side, have been that low.
And can you get a rate that low and still get some IO, interest only?
Yeah, you can. So that's one of the benefits of the Fannie and Freddie programs. So that's one of the things that makes those programs so attractive.
When we're talking about different lenders, are they more or less aggressive in different markets and submarkets, or like, do agencies have to give the same pricing in every market regardless of market dynamics? Does it work like that, or how does that work?
So specifically to the agencies, they kind of tier markets. So your tier one markets will be your New York, your Chicago, Los Angeles, really the real market drivers of the country where you've got a lot of high population demographics. So they might be priced a little lower than what a St. Louis might be, but they're probably relatively close. They're probably only a few points off.
Got it. And then what about for life codes?
So they might price in a little bit of where that location might be if it's like if it's one street off or whatnot. But generally speaking, you know, you're really going to be within 5 to 10 basis points of anything else.
Got it. So I've been kind of keeping the conversation focused on multifamily and not looking at other types of real estate. So if you don't mind, can you speak on retail, industrial, or just other asset classes or asset types, and what that looks like if an owner of one of those types of properties is working with you, and what loan avenues may exist?
hmm Yeah. So our life company lenders especially love, as we've talked about, multifamily. They love industrial and they love retail. Specifically on the retail side of things, they like the neighborhood retail centers. So call it your 20,000 square foot, what have you, retail center where you have the essential businesses, your nail salon, your barber, maybe it's the vitamin shop, the mom and pop's the backbone of what real estate in the small business community is. But what they also like too is the grocery anchored shopping centers with some inline as well. They don't want to get too heavy on that in terms of the inline retail strip attached to the grocery anchored. But if you have a long term grocery anchor in place, then they will love that, especially if you can get some sales to see how strong the grocer is. Then life companies will be able to eat that up all day. And typically, you might be looking at anywhere between 160 to 180 spread over the 10 years. So kind of going back to that, that'd be 590 to a call it 6.1% loan as it sits today with the 4.3% treasury.
That's pretty good.
Yeah.
Is there a loan amount where it just doesn't make sense? Like, is there a minimum loan amount where the fees or the cost of reports and stuff like that will not make sense for you to do the deal?
Yeah. So I'll say this in general is we have the capability to do loans as little as $1 million and then as big as 100 million plus. I closed two $1 million deals in the past 12 months. And I mentioned I closed a $20 million deal. But our loan sizes that we really find that the numbers do make sense is going to be that 5 million to probably 5 million and up. With our lenders, at least in the Midwest, we find that we are most competitive at 5 million to probably about 40 million, with, that 5 to 40 million being, we're going to get the most amount of life insurance company quotes. And then if we go above that, which we can, it's just that it might be a more limited pool due to the amount of loan proceeds that need to be put in.
And you do a lot of work in St. Louis, but you've also done deals outside of the St. Louis MSA, correct?
Yeah, that's correct. We're not necessarily limited by geography. We work with a lot of sponsors in St. Louis, but we have clients that aren't located in St. Louis, but we can also follow the sponsors wherever they go. Historically, I've closed loans in over 30 plus states, and Gantry as a company, we've done business in 48 or 50 states. So we don't necessarily have a geographic footprint overall that we need to be concerned about.
Got it. When we've talked a lot about real estate, but I'd love to hear, like you mentioned early on, that Joe is a mentor for you. Is he one of the reasons why you've been able to go from, not knowing anything your first day to where you are today? Like, is it extremely important for someone in your business to have a mentor, would you say?
I would say undoubtedly it is to both of those. Joe, one of the reasons I love working with Joe and have as much experience as I do is because it's always been a high volume shop. So the amount of loans that I've seen the amount of loan requests that I've seen come through to find out what works and what doesn't work, what is likely to get done versus
Versus what you guys might pass on?
Yeah, versus what we might pass on, whether it's due to leasing constraints or occupancy constraints, or the location, quality of asset, what have you. That's a very big part of it. And then that's just talking about the analyst and closing side of things, and then and then he's a very big mentor for me as starting to hit the ground running as a producer as well. His insight and knowledge and his experience in how to handle situations to get, especially in negotiations and to get things across the finish line, is undoubtedly one of the reasons why, I've had this success, what little success I've had, and hopefully will keep growing into the future.
And you have to have a kind of long-term mentality as a producer, right? Because like you're not going to hear yes, I'm assuming, on your first phone call. How do you think through that, like in terms of just building relationships, your networking, and continuing to put yourself in front of or around the people you want to be around?
Yeah, I mean, it's very rarely you're going to get a yes on the first call or that first deal to come through from a client that you're actually going to be able to get something done with. I mentioned the sponsor that closed a Fannie Mae loan with earlier this year. That was 5 years in the making. I reached out to him after he did one of his first projects. He had moved on to some bigger projects as well, and then he thought very well of me in our shop, as well as he'd met Joe. So he had a lot of trust in us throughout the years that was built up. Now, that being said, sometimes that first call does happen. I was in a new market with one of our other producers, and we had randomly met a sponsor. And next thing you know, and that was earlier this year, we just got 2 deals signed up. So it doesn't always happen on the first try, but you do have to grind, and it's a tenacity game. You got to be able to take the no's. There's going to be days or a week that, things aren't going to go your way, but you just got to get back up with a smile on your face and keep going.
One thing I do like a lot about you is you come across as very genuine. Like you're a producer, yes, but you don't have like a salesperson's persona. And I'm not saying that's necessarily a negative thing, but I appreciate that you're very straightforward and honest, and you look at deals with an underwriter's mentality versus over-promising, if that makes sense.
Yeah, no, I appreciate that, because that's one thing that, kind of going back, that's one thing that's been taught, that Joe had taught me is, your reputation is your livelihood. We don't want to, make a bad loan and then someone, they have regret on that. Next thing you know, word's getting out of the market that you're selling something that someone doesn't want. That's not what we're here for. We're here to help a young guy, help anyone that wants to grow their they want long-term fixed rate financing, and we may not be their first shot. It might be that, someone like yourself, probably you acquire an asset, you go to a community bank first, more than likely, because you need to be able to have working capital to improve the property. But once you stabilize it, we hope that you guys, sponsors, think of us to say, hey, Mitch, you've given us plenty of market insight. You're always up to date. Can you take a look at this? Let me know what you think it's worth, what you can do. And hopefully from that point, we're given the opportunity to be able to execute for them.
I love it. It makes a lot of sense. And you're totally right. We go to community banks always on the acquisition, and then we go perm on the refi once stabilized. We've talked a lot about real estate. I want to be respectful of your time, and I do appreciate it, Mitch. We end each show with what we call a hole-in-one. Mm-hmm. And I hope you brought something, because you've shared a lot, but I'm sure you have something. So just your greatest piece of advice that you can give to anyone listening or watching that they can implement in their life or business.
Yeah, I mean, I like to keep it simple. And with that, just do it. As Nike said, if you're wanting to get something started, you can make the greatest of business plans, but, until you put it into action, whether it's, starting a business or trying to cold call and get your business, like for me, it's cold calling, I'm emailing, I'm talking to people. Just do it. Pick up the phone and, get the ball rolling.
I like it. It's easy to remember and easy to implement. So thank you for sharing. I appreciate it.
No, thank you. Once again, I appreciate the opportunity and your time, and for giving me the platform, you lending me your platform to spread the Gantry name, and looking forward to getting some deals done.
Yeah, and you'll see me wearing this.
Awesome, man. No, it's good gear. We know high quality, just like the people at Gantry. So
I love it. That's awesome. Thanks again.
Thank you.